Imagine you're standing on a ship in the middle of a violent storm. Waves crash against the hull, alarms blare, and passengers clutch the rails with fear in their eyes. Everyone is looking at the captain. He holds the power to act, to flood the ballast tanks and steady the ship. But he hesitates. Wait too long, and the vessel could tip, sending everyone into the sea. That captain right now is the Federal Reserve. And the lever? Interest rates. For more than a year, the Fed has kept rates sky high, trying to strangle inflation. But now the seas have changed. Unemployment is rising. Job growth has slowed to a crawl. And the economy feels like it's teetering on the edge. The burning question is this: will the Fed act fast enough to keep the ship afloat? Or will hesitation doom us to a deeper recession? Today, on BrainFuel Reads, in our What If series, we're tackling a critical scenario. What if the Fed cuts rates too late? Stay tuned, because this isn't just about economists or Wall Street. It's about your mortgages, your credit cards, your job security, and whether the Fed's hesitation could cost every single one of us. To understand where we are today, we have to rewind the story. Just a couple of years ago, the US economy was running hot. Demand was surging after the pandemic, supply chains were snarled, and prices began to soar. A trip to the grocery store turned into sticker shock. Gas prices punched holes in family budgets. Even a cup of coffee you have every day seemed to climb higher every month. Inflation, something most Americans hadn't really worried about for decades, became the villain in everyone's daily lives. And that's when the Federal Reserve stepped in. They pulled their most powerful lever: interest rates. For over a year, they raised them again and again, to levels not seen in more than 2 decades. Mortgages doubled in cost. Credit cards felt like traps, with interest piling up. Small businesses that relied on loans suddenly struggled just to keep the lights on. The Fed's strategy was clear: make borrowing painful, slow down spending, and force prices to cool. And at first, it seemed to work. Inflation, which once raged like wildfire, began to come down. But here's the catch: the effects of high rates don't hit immediately. They creep in slowly, like medicine that takes time to circulate through your body. And now, as those effects fully settle in, the signs are unmistakable. Job growth has slowed to a trickle, and unemployment has surged to its highest point in 4 years. This is the delicate moment we find ourselves in. The storm is here. The water is rising. And the Fed is still holding its hand on the lever, waiting. Right now, the Federal Reserve finds itself in a precarious balancing act, grappling with a two-front war that threatens the economy's stability. On one front, the specter of rising unemployment looms large. Families are feeling the pinch, layoffs are spreading like wildfire, and job security has become a distant memory. In normal circumstances, this would be a signal for the Fed to swoop in and cut interest rates to get the economic engine revving again. But lurking on the other front is the relentless tide of inflation. New tariffs are pushing up the prices of imports, energy markets are as unstable as ever, and wages, though cooling, remain elevated compared to pre-pandemic levels. A hasty rate cut could risk igniting the very inflation the Fed has painstakingly tamed. It's like standing at a crossroads where every path leads into a storm. Cut too soon, and inflation could flare back up, spiraling out of control. Cut too late, and the economy could sputter to a halt, leaving recovery a distant dream. So where does the Fed stand now? In their public statements, Fed officials echo one recurring theme: patience. They repeatedly insist that the economy remains fundamentally robust, that inflation is not yet vanquished, and that caution is their best ally moving forward. Yet the markets are singing a different tune. Traders are placing hefty bets that the Fed will make rate cuts at their next meeting. Wall Street isn't just speculating, it's demanding action, stirring the pot with an urgency that grows louder by the day. Meanwhile, households find themselves caught in the middle of this tumultuous crossfire. Mortgage rates hover around their highest levels in 2 decades. Credit card debt has surged past a staggering $1.3 trillion. And small businesses are grappling with the burden of costly loans. crippling their ability to thrive in this uncertain economic landscape. Every month, the Fed hesitates. The cracks in the economy widen, threatening to become deep chasms that could swallow livelihoods. Next, let's play out the scenario. What happens if the Fed hesitates just a bit too long? First, the unemployment rate creeps upward. From 4.3% to 4.7%, then 5% and beyond. Every small increase in these numbers represents hundreds of thousands of jobs being lost, with layoffs that start in manufacturing and tech rippling outward to retail, hospitality, and service sectors. Next, consumer spending takes a nosedive. People tighten their belts, cancel vacations, and skip nights out. Businesses reliant on discretionary spending, restaurants, small shops, travel agencies, feel the brunt of this shift, struggling to stay afloat. Then, the confidence that once fueled growth begins to crack. Stock markets tremble, housing prices stagnate, and households start to sense a tightening grip of financial precariousness. That fear feeds back into the economic slowdown, creating a vicious cycle with no clear exit. By the time the Fed decides to ace, the damage could be irreversible. Interest rate cuts do not work like a magic wand. They take time to filter through the economy. Jobs that have been lost cannot be resurrected, nor can the fear that pervades consumer sentiment disappear overnight. This is the nightmare scenario. The Fed acts, but too late to stop a full-blown recession. We've been here before. Back in the early 1980s, the Federal Reserve decided to keep interest rates high to battle inflation. The outcome? A painful double-dip recession that left deep marks on the economy for years. Fast forward to 2007, when the Fed misjudged the dangers lurking in the housing market. By the time they slashed rates, the financial crisis was already spiraling out of control. History teaches us that when the Fed hesitates, the fallout can be severe. Jobs don't come back overnight. Businesses can't just flip a switch to start hiring again. Plus, trust, whether in the markets, policymakers, or the economy itself, takes a long time to rebuild. And let's not forget the political angle. The economy isn't just about charts and numbers, it's about people and votes. If unemployment continues to rise into 2026, it could dramatically reshape the political landscape. High joblessness tends to hurt the party in power, spark populist anger, and shift the balance of power in Washington. Even though the Fed operates independently, they can't ignore that pressure. Every decision they make about interest rates can affect elections, policies, and the country's future direction. In other words, cutting too late isn't just an economic mistake. It could become a political earthquake. So, what's on the horizon? The Fed's upcoming meetings are going to be crucial. Markets are expecting interest rate cuts, but the size and timing are still up in the air. Some experts argue they should cut aggressively, by 50 basis points or more, to get ahead of the downturn. Others caution that moving too quickly could trigger another wave of inflation. For everyday people, the best strategy is to stay prepared. This means paying down high-interest debt if you can, building your savings, and keeping a close eye on policy changes. Whether you're hoping to buy a home, expand your business, or just keep your job stable, the Fed's decisions in the coming months will have a direct impact on your life. So let's return to our central question. What if the Fed cuts rates too late? If they hesitate, the U.S. could slip into a recession that might have been avoided. Jobs lost, businesses shuttered, confidence shaken. By the time the medicine is given, the patient may already be in intensive care. That's why timing matters. That's why these decisions aren't just abstract debates among economists. They actually shape the world we live in. Thanks for joining me here on BrainFuel Reads for another episode of our What If series. If you found this breakdown valuable, please hit that like button, subscribe for more deep dives, and let me know in the comments. Do you think the Fed is waiting too long, or are they right to stay cautious? That's it for today. And as always, keep your brain fueled.